Hi, I'm Josh Goulding, co-founder of 4J Wealth Management, and today I want to talk to you about investing in retirement. Most retirees, when they get close to retirement, they want to make their portfolio very conservative because they're fearful of a market drop and not having enough money for them to make it through retirement. What we do to help simplify and make retirees less anxious is we do something called the bucket approach. The bucket approach is where you mentally divide your portfolio into two buckets. The first bucket is basically everything you're going to spend from your portfolio over the course of a year multiplied by 10. You invest that money in a portfolio of very conservative investments like money market, CDs, and investment-grade bonds. But let's simplify this a little bit. Meet Chris. Chris worked hard for 40 years and recently celebrated his retirement. Chris reaches out to 4J Wealth to begin investing in retirement, and we begin to implement the bucket approach. Starting with bucket 1, we'll call this the conservative bucket. We need to determine how much Chris needs for living expenses. We determine that Chris will need $40,000 per year for living expenses for him and his family. We then multiply this number by 10 and keep this money in the conservative bucket to allow a 10-year buffer for Chris and his family to feel more secure in retirement and in their investment approach. Moving to bucket 2, we'll call this the growth bucket. We invest this money in a diversified stock portfolio, and that is the bucket approach. But let's break this down even more. Let's take a look at the growth bucket and the conservative bucket and what we find in each. First, the conservative bucket. Remember, Chris's conservative bucket is going to be filled with 10 times his yearly living expenses to provide that 10-year buffer. If Chris's living expenses are $40,000 per year, we multiply that by 10 and make sure we have $400,000 in conservative investments. We fill this bucket by investing in conservative investments like money market, CDs, and investment-grade bonds. And we always make sure the conservative bucket is floating right around that $400,000 mark to maintain that 10-year buffer. Moving on to the second bucket, or the growth bucket. Chris's growth bucket is that everything else bucket. We fill it with higher risk investments like stocks. Remember that saying, high risk, higher potential reward? As long as we have that 10-year buffer in our conservative bucket, we can feel more confident with more volatility in our growth bucket. And over time, this growth bucket is where Chris may make the bulk of his profits. Let's take a look at the growth bucket and the conservative bucket in a positive year versus a negative year. In a hypothetical negative year, when the stock market goes down, Chris will see his portfolio go down in his growth bucket, but his conservative bucket is unlikely to go down much, if at all. Therefore, Chris doesn't need to have as much panic when he sees his portfolio go down because he has that 10-year buffer to live off of in the conservative bucket. Now let's look at a hypothetical positive year. The stock market is having a positive year, so Chris's growth bucket might be up 10%. Since we took $40,000 out of Chris's conservative bucket for his yearly living expenses, we'll refill that $40,000 from the growth bucket. So if Chris had $1 million in his growth bucket, then grew 10% in profit during the positive year, he now has $1.1 million in that bucket and $100,000 in gains for that year. We'll take $40,000 of that $100,000 and put it into Chris's conservative bucket. And now both buckets are full. His 10-year buffer is safe, and his growth bucket is up $60,000. And this brings us back to the root of the bucket approach. What the bucket approach ultimately creates is a situation where you can have a bad quarter in the market or a negative year, and you know that you have 10 years worth of living expenses set aside in your portfolio in investments that are not invested in the stock market. What this allows you to do is actually have the potential to achieve more growth over time because you still have a significant portion of your nest egg invested in investments that are long-term in nature, like stocks. And that is the bucket approach with 4J Wealth.